Imagine this. China cuts off rare earth exports. The United States responds with fresh tech bans. Wall Street calls it a bluff. But then the dollar doesn't just dip, it tumbles. Not slowly, but nonstop, for 5 months straight. This isn't about new tariffs. It's about a spreadsheet, quietly triggering a global panic. In May, Washington threatened a global tax war, wrecking trade talks and leaving American banks holding bonds nobody wants. Even close allies started pulling back. Trump framed it as tough negotiation. But the market saw something far worse, a full-blown crisis in motion. So what breaks first, trade, trust, or the entire financial system? In a move that ignored both logic and diplomacy, Trump claimed he struck a quick deal with China to save Beijing from collapse, citing civil unrest and mass factory shutdowns. But no evidence surfaced. In fact, Bloomberg reports China's industrial output rose 6.2% year-over-year in April. A 90-day tariff suspension was agreed in Geneva. U.S. duties dropped to 30%, China's to 10%. But at the same time, the U.S. Commerce Department imposed sweeping new restrictions on China's access to chip design software and critical chemical shipments. Reuters confirmed that even existing export licenses were suddenly revoked on May 29th. Washington calls it a containment strategy. Beijing sees it as sabotage. The deeper question: was this rescue ever about stability, or was it a setup for collapse? Treasury Secretary Scott Bent flew to Switzerland to avoid a market meltdown, brokering a short-term pause that neutralized $145 billion in reciprocal tariffs. But China's reaction? Muted at best. CNBC reports Beijing hasn't lifted rare earth export controls or sped up licensing despite promises in Geneva. Trade Rep Jameson Greer told CNBC. "We haven't seen the flow of some of those critical minerals, referring to rare earths vital for AI chip production. China's Ministry of Commerce claims their pace follows international norms and is necessary for dual-use review. This isn't bureaucratic delay, it's strategic ambiguity. If Bent hoped China would meet the U.S. halfway, early signs say otherwise." Wall Street has turned U.S. trade policy into a running joke, one with real profits. The Financial Times called it the Trump walk-back markets plunge after tariff threats, then bounce back once Trump walks them back. Case in point, the S&P 500 rose 2.1% on May 28th, right after Trump delayed a proposed 50% tariff on European imports. But here's the danger. Adam Crisafulli from Vital Knowledge notes, "Investors are starting to feel too comfortable with this White House rhythm. Moody's downgraded the U.S. credit outlook, citing unpredictable fiscal policy. If Trump doesn't walk back this time, the market, which is built on the assumption he will, could face a painful shock. This isn't just about stocks anymore. It's about trust, and whether Washington still plays by rational rules." Trade numbers are collapsing. The U.S. Census Bureau reported goods imports fell nearly 20% month-on-month, the sharpest drop ever, right after March's Liberation Day tariffs. Consumer spending, which powers nearly 70% of U.S. GDP, slowed to 0.1% growth in April, down from 0.7% in March. This isn't just weakening demand, it's a full stop. Households who bulk bought in the first quarter are now living off stockpiles, not shopping. Beneath the surface are rising prices, uncertainty, and growing tension. The tariffs meant to punish China are backfiring, hurting domestic consumption. At the same time, U.S. exports are also declining. The entire cycle of trade-fueled liquidity is breaking down. If Washington's goal was to weaponize trade, that weapon is now turning inward, damaging its own economy. Since its peak in December, the U.S. dollar index has dropped nearly 5%. Bloomberg reports June will be the 5th straight month of decline. This isn't a random dip, it's fading confidence. The Institute of International Finance notes foreign holdings of U.S. financial assets, mostly from Asia, have climbed to over $7.5 trillion, built over decades through trade surpluses funneled into U.S. bonds and equities. But with Treasury yields unstable and confidence in U.S. fiscal policy shaken by political deadlock and unpredictable trade moves, even loyal investors are reconsidering. A weaker dollar usually boosts exports, but not when exports are collapsing and consumer demand is stalling. The real danger isn't just capital flight, it's the collapse of the entire narrative. If the dollar no longer symbolizes strength, the foundations of global finance start to shake. And if foreign money starts to exit, how long before that trickle becomes a flood? Treasury Secretary Scott Bessent believes China will come back to the negotiating table once Trump clarifies his stance. But that's wishful thinking. There's no evidence Beijing is ready to budge. Even Japan, where 28% of GDP depends on U.S. trade, hasn't bowed to American pressure. This is no ordinary trade war. It's a crisis in motion, one with uncertain consequences for global markets and the future of the world economy. Meanwhile, America's trade deficit has exploded, reaching $1.22 trillion, up from $850 billion in 2021. That's a staggering 41% increase in just 4 years. According to the U.S. Bureau of Economic Analysis, the country's net international investment position has now plunged to minus $26 trillion, its worst on record. That figure reveals just how much of America is now effectively owned by overseas investors. And here's the kicker. While Washington loves to point fingers and accuse others of manipulating the system, the real irony is that the U.S. runs huge deficits, prints dollars to cover them, and calls that strength. But what happens when the rest of the world stops trusting the borrower? In May, U.S. Treasuries logged their first monthly loss of 2025, with total returns dropping 1.2% across all durations, as reported by Bloomberg. Since 2020, long-term bonds have suffered over 7% in cumulative losses, even after including interest payments. Regional banks are now sitting on $413 billion in unrealized bond losses, according to the Federal Reserve, echoing the same weaknesses that triggered the Silicon Valley Bank meltdown. And as foreign interest in treasuries wanes, these banks may have to soak up even more government debt, putting them at greater risk. Here's the problem. If they acknowledge these losses, they risk shattering market confidence, or worse, facing solvency issues. Yet officials like Bessent still expect Wall Street to jump in and keep buying more debt. But this isn't just bad timing. It's a full-blown policy trap, where the few willing buyers are running low on resources, and the desperate sellers are piling on more paper. Buried inside Trump's sweeping legislative plan is Section 899, a vague and quietly written clause that could essentially activate capital controls without even announcing them officially. This clause threatens to slap extra taxes on companies or investors from any country the U.S. Treasury deems to have unfair foreign tax practices. And here's the catch. The U.S. alone gets to make that call. That's raising red flags globally. J.P. Morgan analysts warn that even countries following OECD rules, like France or the U.K., could be caught in the crosshairs. And the timing couldn't be worse. The U.S. Treasury is set to auction around $300 billion in new debt this quarter, according to the Congressional Budget Office. But foreign participation in these auctions has dropped sharply, from 72% last year to just 57% now. If Washington starts targeting global investors with penalties, that downward trend could speed up dramatically. And when investors start pulling money out, fearing they'll get stuck or hit with extra taxes, the damage isn't just about lost dollars. It's about the U.S. dollar becoming a financial quarantine zone, repelling the same international capital it desperately needs. Remember the so-called Geneva Truce that was meant to cool things down diplomatically? It's been nearly 3 weeks, and Beijing still hasn't lifted its export ban on rare earths, materials critical to many global industries. Meanwhile, Trump is now threatening new tariffs on European cars, and Bessent's claim that a deal is close remains vague and uncertain, only adding more stress to the situation. At home, U.S. consumer demand is clearly weakening. Inflation is stuck at 2.3%, and Treasury auctions are leaning more and more on fragile regional banks for support. But things have also taken a turn beyond economics. The U.S. is now canceling student visas and rolling out export bans, shifting the conflict into the ideological realm. Reuters recently reported that China's Ministry of Commerce has urged the U.S. to correct its wrong practices, language that in past trade fights has preceded retaliation. If diplomacy is built on communication and trade on trust, the current state of affairs shows that the U.S. is short on both. And now the big question isn't just about who blinks first, but whether either side still sees anything worth saving in this strained relationship. We're standing on the edge of a possible collapse of the trade truce. The dollar is weakening. The economy is feeling the pressure. Treasury auctions are drawing fewer buyers. Consumer spending is drying up, and foreign investors are quietly stepping back, rethinking their confidence in America's financial stability. Still, Washington shows no signs of shifting course. With tariffs in one hand and threats in the other, the administration continues betting on assumptions that no longer reflect reality. So here's the question. If China stays firm, if global investors walk away, and if U.S. banks are forced to shoulder more risk than they can handle, what breaks first? Will it be the bond market, the dollar's global dominance, or just the illusion that Washington is still in control? Drop your thoughts and predictions in the comments below, and ask yourself, what if this standoff isn't a blip, but the new normal? Thanks for watching. If this breakdown helped you understand the situation better, hit that like button and subscribe for more dives like this. And don't forget, another powerful video is waiting for you on your screen right now.